Hello, and thank you, Hannah, for introducing me. Actually, this paper has been suffering a lot of updates recently. We changed the name of the paper. I have a team of stars here on board with me on the paper. Wilcon, who's in the conference, and Ed Maida, who's an expert in tax, and Wayne Landsman for UNC. And we're probably gonna change the title in a couple of weeks. So that's what it is. Thank you for the conference organizers for putting an amazing conference, amazing program, especially Evgeny. I think we are all already looking forward for the next event and hopefully in person here in Tel Aviv. So this was an amazing year for investors. According to the Forbes 2021 billionaires list, we have 9 new crypto billionaires in the list. I'm not there, otherwise I'll not be here presenting the paper. But what that shows is all this profitable market is on the interest of the tax authorities, which also wants to have a bite on the stake. A little bit of background. There's a lot of uncertainty in tax reporting, originated in 2014 with IRS, declaring trading on cryptocurrencies as a property, and that generated a lot of confusion with like-kind exchange transactions. People didn't know exactly what generates a taxable event. And there's several others things that makes tax report complex. There's a lot of trading platforms, different type of assets, and types of acquisition of crypto, purchase, grant, mining, hard fork, so on and so forth. And some loopholes. Interestingly, for securities, you cannot sell a losing position and buy it back. You have to wait for 30 days, and on crypto, you can actually do that. So some traders may exploit the system. And of course, adoption comes first, and then regulation tries to pick it up. If you look into it, every 2 or 3 years, there's a new set of crypto products. Then the market demands some clarity, and that pushes some regulation a couple of years later. So we try to understand what's going on here. There's some effective, new tax rules that will become effective in the next couple of years. We're also looking to how that affects crypto trading. So what we do, we have 2 analyses in this paper in which we explore the aspects of tax Wild West in the crypto space. One is we're looking at how traders or retail traders respond to an increased tax scrutiny by the IRS. And the second part, we look into the trading books of large crypto exchanges and try to provide some evidence and estimate the size of tax loss harvesting. So tax loss harvest is essentially selling a losing position, buying the asset back, so you keep the same quantity, but you can use that loss information for tax purpose. This is one ad that was in I think it's in some subway in New York, where an accounting firm claims that you can make money with Bitcoin when the price goes up, and when the prices goes down, of course, in the down part is related to tax loss harvesting opportunities. All right, so it's examining the crypto space is interesting for the regulatory perspective because it's a quasi-experimental setting. It comes from an unregulated environment. There's also other cool features here. I saw a lot of types of investment opportunities, and it's a Main Street dominated market. Now, just to give an intuition of where we are heading here, if you search for capital gains, you can see there's some seasonality on Google search that happens in the early 3 months of the year, which coincides with the tax reporting period. However, if you search for Bitcoin tax, that seasonality is not so evident, but that correlates almost perfectly with Bitcoin price. So this is quite interesting. 2 things. One, there's some asymmetric Google tax search behavior, which may indicate that investors treat tax on crypto differently than regular securities. And the second thing is, if you look into the end of the period, this kind of the 2 searches converge, which shows that Bitcoin is becoming more popular part of the traditional assets portfolio. So the first analysis, we look into 500 large retail traders response to IRS scrutiny. And the question is basically, do traders respond to IRS scrutiny? So the data is provided by, it's proprietary data provided by a tax accounting firm specialized on reporting for crypto traders. 1/3 of the data and 1/3 of the traders are US-based, 2/3 are international. The firm did not provide any information on the traders because that's confidential, but we informed that from which local currency that those traders are using. That's 1 million trades for the period. Is quite substantial for an empirical analysis. And this data is essentially reports or trading reports with information on the pairs, on the fees collected, the transaction size, and the name of the exchange. We had to calculate returns. We use first in, first out approach, no trivial task because the complex mapping across different positions and different exchanges, a variety of acquisition firms, and that's essentially why traders actually look for a third party to do so. All right, so here's some glance of the data. Most of the data on the traders side falls in the turn of the year 2017, 2018. This is quite substantial for retail traders on an average daily, $17,000 in 23 transactions. There's some diversity on number of currencies and crypto exchanges that change over time. Returns are often positive, with some happy trader in a specific day making more than 60%. The traders trade more winning positions than losing positions. That's good for them. 1/3 is the US based. 62% of the assets are usually tokens originated in ICOs, and 40% is the period of IRS scrutiny, which is early 2018 until early 2019. Now, if we compare the two groups, the US-based international peers, they're quite balanced in key characteristics, but we still do some matching here just to have a clean comparison. And the first analysis we look into is whether a domestic trader in the IRS period, what's the reaction in several variables. So you can see, for instance, an US-based trader decreases the number of trades and substantially decreases the amount of volume. And that reflects this attempt to decrease the amount of taxable events. There's some increase in diversity when you look into this, what they are doing. They're actually going for lending, centralized lending, or lending their assets. That's to lock in returns for the long term. There's no effects on profit, but however, harvest is increased for the US based, and harvest here is basically assets that are sold and bought within 30 days. There's not much difference in the matched samples. Another aspect we analyze is whether there's any effect on exchange preferences. We say that there's some small decrease on the number of exchange traded. This also reflects an attempt to decrease the number of taxable events. Some maybe counterintuitive to start with results. There's some move to trusted exchanges, some small but significant effects. Those trusted exchanges are exchanges located in the US or with high compliance measure in place. There's some run from centralized exchange, some caveat here because the data goes until 2020. The centralized exchange picks up mid-2020, for sure 2021. So that may change with an update in the data side. However, the US traders run away from exchanges located in crypto-friendly countries and in tax-haven countries. And to conclude this analysis, we break down the traders trading data at the granular level, and you see in the period of time with a new interaction, in the period of time where that's more sensitive to tax and tax sensitive, it's the end of the year, and you can see that US-based traders during the IRS scrutiny, they increase drastically the number of losing positions. They sell losing positions way more at the end of the year. That's clearly tax motivated. Now we should break down that on whether this is a harvesting trading strategy or a regular one. We see that tax harvesting is what dominates the trading strategy at the end of the year. All right, so do traders respond to our scrutiny? Yes. How they lower taxable events, and there's some run to trusted exchanges. Perhaps some of this move is for traders looking to benefit of tax reporting. Of course, they want to report losses. But the tax loss harvesting dominates the end of year trading strategy. So isn't on the stone on the tax loss harvesting that we move to the second analysis in the paper, which want to generalize and try to cover a large portion of this activity. So we go for the 34 large crypto exchanges, which includes 5 crypto exchanges that are based in the US, Kraken and Coinbase is here. We focus on one in particular pair, Bitcoin to US dollar or to Tether, is a very liquid pair. I'm gonna explain why in a moment. There are 3.2 billion trades in the period, and $5.2 trillion is quite a substantial amount. The variable of interest that we're looking here is a wash trade variable. In this paper, we determined the wash trade as a sell and buy order that occurs in the same pair, the same exchange, at the same quantity price, and within 6 seconds. And to make that variable comparable across exchange, we scale it to the total trade. So in the end, the variable is the percent. Now, why washing trades? What we know comes from practitioners with the Bitwise report to the SEC, showing that a lot of crypto exchanges, they fake volume. And from the literature of Kong Li, Tang Yang, Lucian Li, in a paper I have Dan Amber and Evgeny Andres. I'm glad that Kong's here and Li's here too. So we have different approaches, but I think we all agree that there's endogenous considerations and crypto exchanges fake volume in order to gain traction and climb in the list of coin market cap volume and attract customers in revenue, kind of in the short run, along mid run. And this is the endogenous in what we know for washing trades. So why I'm talking about washing trades is because we believe we can show that washing trades also have exogenous considerations. First, if you rank crypto exchanges by washing trades percent total trades, and we slice the sample between low compliance exchanges and high compliance, where compliance is based on KYC and anti-money laundering measures in place, you see that low compliance crypto exchanges have a large percent of washing trades to total trades than high compliance exchanges. And you see here US-based crypto exchanges, including Binance. Now, our assumption is, if you look into high compliant crypto exchanges and very liquid pair, such as BTC and to Tether, then washing trade that are observed may be exogenous. So what we do, here you're seeing the plot of Bitcoin price scaled to its peaks at the end of 2017. And after 1 year, the price has a decline of about 70%. So if traders bought Bitcoin at the end of 2017 are still holding it, after 1 year, during this period, which we call the potential harvest period, there's a no realized loss in which can be used. So what they can do, they can sell those Bitcoins, buy it back, keep the same amount of assets, but use the loss information for tax purpose. So that's the idea. And if you analyze washing trades during the harvested period, this is what happens for Coinbase, from Kraken, Binance. They almost agree with the shape of the pattern with a huge spike on wash trades. And for us, because those are higher compliant crypto exchanges, they don't have endogenous incentives to wash trade. This is mostly, wash trade here becomes a proxy for tax loss harvesting. That can even be seen on OKEx, which is a low compliant crypto exchange. However, as you can see here, those is what we're capturing the other papers talking about endogenous considerations. All right, now that we know how to capture that, do some analysis. I won't cover all the statistics here, just the main variable that's interesting. It's the washing trade to percent of total trade. Depending on that median or mean, there's a variation of 13 to 18%. That's a daily variation of wash trades with some high variability. Of course, that depends on the time, depends on the exchange. Some days, some exchanges will have 100% of fake volume and others will be 0. And that's a 6.6 million on daily average on wash trades. Now, if you run, we run here in the regression with an indicator for the harvest period and an indicator for regulated exchanges. And regulated exchanges, there is this list here, and all the exchanges that are regulated in the US, UK, or Japan, then you can see that most of this washing trades are driven by regulated exchange throughout the harvest period. And you can break down that into Coinbase, Kraken, and so on and so forth. Now that we're using, there is exogenous incentives from wash trades. The argument is the high liquid pair BTC to Tether, and regulated exchange may have no endogenous incentives. However, we show evidence that wash trades peaks through during the tax harvest period, which may be a proxy that can be used. So now that we know how to estimate the tax loss harvesting, we can calculate the revenue. So what we do, we calculate the wash trade median. Here we're looking to the plot for Binance, and then you calculate the washing trade during the harvest period, and then, of course, the differences, the revenue. Now, if you do that across all exchanges in percentage, you can see that during the harvest period, that's 18%. During the regular period, it's about 5%. In dollars, this area, and for all exchanges, corresponds to over $200 billion, quite substantial, with half of it coming from regulated exchanges and 1/4 of it coming from Binance. Of course, not all this can be used for tax purpose. So, a simple math is calculating the devaluation of Bitcoin for 2017 to 2018 and the average capital gain. So this amount that you see here in the bottom is what could be used for tax purpose. Just put the number in context. In 2018, the federal capital gain tax revenue was about $160 billion. If you get that portion back, this is an increase of 10 to 50% tax revenue. That's only Bitcoin, which is quite substantial. So, so let me just give one more piece of information and then conclude the paper. I'm not sure if I'm going too fast. I'm not taking account for the time. There's a new bill that has passed, which will implement that traders can no longer exit a losing position and buy it back in 2022. And probably the math that politicians did is something similar to what we did, and showing that may have some increase in an expected increase in revenue by the tax authority. We think that's an unrealistic scenario because this is the same. It's expecting no market reaction. Now, more realistic scenarios, potential adverse effects that affects crypto trading and reporting. For instance, run from US for non-US based crypto exchanges, which will definitely affect the quality of reporting, may create incentives for tax evasion facilitated by the anonymity of crypto trading, and a run for innovative products that we already see in the data, some demand for non-fungible tokens and centralized finance applications that the tax authority has not yet provided the guidance. So in a realistic scenario, we believe that after the bill, the tax revenue may be smaller than pre-bill tax revenue. So that's it with the paper. I appreciate the opportunity, and I'm looking forward to the discussion and the audience comments.